The silver wipeout. Why bullion dealers are selling out after the decline. Silver just dropped, exactly what every trader expected. But here's what they didn't see coming. While the price fell, dealers across 3 continents began shutting their doors, not because demand collapsed, because their vaults went empty. In 2008, this pattern preceded a 400% surge. In 2020, it happened again. Now, the same signatures are appearing. But this time, there's a difference. Central banks aren't waiting. Industrial buyers aren't hesitating. And the physical metal is vanishing faster than any decline in recorded history. What do they know? That the market hasn't priced in yet? Welcome to Financial Inspection. You've just entered a space where we examine what others overlook. If you've been navigating markets long enough to remember when a handshake meant something, when due diligence wasn't optional, and when understanding the fundamentals actually mattered, then you already know the best intelligence doesn't come from headlines. It comes from patterns most people never see. Do us a favor. The way neighbors used to look out for each other. Hit that subscribe button, because the analysis we're about to share doesn't appear on any mainstream ticker. And tell us, where are you watching from today? What part of the world? What market? What time zone? Because what's unfolding in the silver market doesn't respect borders. Now, let's examine exactly what happened and why it matters to your business decisions. On March 14th, silver did something it had done dozens of times before. It dropped 7.2% in a single trading session. Traders who had seen this pattern for years barely blinked. Another correction, another opportunity, another cycle. But within 48 hours, something unusual began appearing in the data, something that hadn't happened during previous declines. The physical market started behaving differently than the paper market, and that difference revealed a crack in the system that few were watching. Silver had fallen from $32.80 per ounce to $30.44 in just under 6 hours of trading. The charts looked exactly like 2013, exactly like 2016, exactly like every other technical breakdown. Analysts published their reports, resistance levels broken, support levels tested, momentum indicators oversold. Everything appeared normal. But in the back offices of bullion dealers across North America, Europe, and Asia, phones started ringing, not with sellers, with buyers. And not just retail buyers placing small orders, these were large orders, institutional size, requests for immediate physical delivery. One dealer in Munich reported 40 orders over 1,000 ounces within the first morning after the decline. A distributor in Texas saw his weekly volume in 4 hours. An online platform in Singapore crashed from traffic. This wasn't panic buying. Panic buying is emotional, disorganized, scattered. This was systematic, coordinated, strategic. Someone, or multiple someones, were treating the price decline not as a warning, but as an entry point. By March 17th, 3 days after the initial drop, the first out-of-stock notices appeared. Austrian Philharmonics, unavailable. Canadian Maple Leafs, 3-week delay. American Silver Eagles, allocation only. Dealers who had managed inventory through 2008, through 2011, through 2020, began using a word they rarely used, unprecedented. Because here was the paradox. Silver prices on the COMEX futures market continued declining, down another 2.1%, then another 1.8%. The paper market was saying, there's too much silver. Sell, get out. But the physical market was saying, there's not enough silver. Buy, get in. One veteran dealer in London, who had operated since 1987, described it simply. In every previous decline, we saw selling pressure in both markets. Paper and physical move together. This time, they're moving in opposite directions, and I don't know what that means yet. What he didn't know was that the disconnect had already been noticed. Central bank trading desks had flagged it. Sovereign wealth fund analysts had modeled it. Industrial procurement officers at solar panel manufacturers had escalated it, because silver isn't just a monetary metal. It's in every solar panel, every electric vehicle, every 5G station, every advanced weapon system, and the entities that need physical silver for actual production weren't waiting for prices to recover. They were securing supply at any premium necessary. By March 21st, 1 week after the decline began, the premium structure had inverted. Normally, when spot silver falls, premiums fall with it. Dealers lower their markup because demand softens, but spot silver was at $29.80, while 1 ounce rounds were selling for $34.50. A $4.70 premium, that's 15.7% over spot. During the 2020 COVID crisis, premiums hit 18%, but that was during a global lockdown. With mints closed, with supply chains frozen, This was different. Mints were operating, supply chains were functioning, production was normal, yet the premium kept expanding because the metal wasn't reaching the retail market. It was being intercepted. Somewhere between the refinery and the dealer, large buyers were absorbing everything, and the data showed exactly who. In the week following the decline, ETF holdings dropped by 8.2 million ounces. But vault inventories didn't increase proportionally. That silver left the ETF and vanished into private storage. Analysts began asking a question they hadn't asked in years. Where did 8.2 million ounces go in 7 days during a price decline? No one had a complete answer, but the pattern was clear enough. Someone was treating this decline not as a market correction, but as a strategic buying opportunity. And they were moving faster than the market could adjust. The anatomy of this decline revealed something beyond technical analysis. It revealed a redistribution from weak hands to strong hands, from paper positions to physical positions, from visible markets to invisible vaults. And it was happening in real time. While most traders were still reading the charts, looking for the next support level, the physical market was already gone. By March 28th, something happened that shouldn't have been possible. A dealer in Frankfurt, one of the largest in continental Europe, did something he had never done in 34 years of operation. He stopped answering the phone, not because he was overwhelmed, not because his systems had failed, but because he had nothing left to sell. His vault, which typically held between 40,000 and 60,000 ounces of retail product, was down to 847 ounces. Mixed dates, random sizes, the remnants nobody specifically orders, and the refinery he had partnered with for 3 decades had just told him something that made no sense. We're producing at full capacity, but we can't allocate to you this month. The orders are coming from somewhere else. Somewhere else. That phrase began appearing in conversations across the industry. A distributor in Melbourne received the same message. A regional dealer in Colorado heard identical language. Production was normal, mints were operating, refineries were running shifts, but the metals wasn't flowing to traditional retail channels. It was being redirected, and no one could identify where. On April 2nd, a bullion analyst in Toronto decided to do something unusual. He called 47 dealers across North America, Europe, and Asia, not to buy, just to ask one simple question. What's your current delivery time frame for standard 1-ounce products? The results formed a pattern he hadn't seen in 15 years of market analysis. In 2019, the average delivery time was 3 or 7 business days. In 2020, during COVID, it stretched to 4 to 6 weeks. In March 2025, before the decline, it was back to normal, 5 to 10 business days. But now, April 2025, after a price decline that should have reduced demand, the average delivery time was 8 to 12 weeks, 3 months, for a product that was supposedly in oversupply. One dealer in Phoenix described the situation with unusual precision. I can get you paper silver tomorrow, ETF shares, futures contracts, mining stocks, any amount you want, instantly. But if you want actual metal, physical bars, you can hold. I'm telling people Christmas, maybe Christmas, 8 months away, for a commodity that had just declined 11% in price. The economics made no sense until someone looked at where the metal was actually going. A procurement officer at a solar manufacturing facility in Vietnam provided the first clue. His company had a standing contract with a Swiss refinery, 50,000 ounces per quarter, industrial grade, for photovoltaic production. On April 5th, he received a notification. Your Q2 allocation has been reduced to 18,000 ounces. We apologize for the inconvenience. He immediately called the refinery. The conversation was brief. We're fulfilling strategic contracts first. Your order is still confirmed, but it's been prioritized below Category A buyers. Category A? He had never heard that term before. When he asked what Category A meant, the refinery representative hesitated, then said something that ended the conversation. Government and defense-related applications. The procurement officer sat with that answer for 3 days. Then he did something unusual. He called 6 other solar manufacturers across Asia, colleagues he had known for years. 4 of them had received similar notifications. Their silver allocations cut between 30% and 65%, all with the same explanation. Strategic contracts. By April 10th, the pattern was undeniable. Retail dealers couldn't get metal. Industrial buyers were being allocated less than contracted amounts. ETF inventories were draining at record rates, but refinery production remained constant, which meant someone was absorbing everything, and they weren't selling it back into the market. A veteran bullion dealer in Zurich, who had survived every precious metals crisis since 1992, described it with unusual clarity. In 2008, we ran out of inventory because mints couldn't produce fast enough. In 2020, we ran out because logistics collapsed. But now, in 2025, we're running out while everything is functioning normally. That tells you this isn't a supply crisis, it's a diversion. A diversion. The metal was being diverted before it reached traditional distribution channels, and the entities doing the diverting had priority access. On April 12th, a small detail emerged that confirmed the theory. A regional mint in Austria announced it was operating at 107% of rated capacity, running extra shifts, weekends, overtime, producing more silver rounds and bars than any period in its history. Yet its largest distributors reported receiving 40% less inventory than the previous year. The math didn't work, unless the mint was fulfilling private contracts directly, bypassing the traditional dealer network entirely. One analyst summarized the situation in a private memo that later leaked to industry forums. We are witnessing a bifurcation of the silver market, the visible market, where prices are discovered and dealers operate, is experiencing a structural shortage, while the invisible market, where strategic buyers operate directly with refineries and mints, is functioning normally. This creates a pricing anomaly that cannot persist indefinitely. Either prices must rise dramatically to reflect physical scarcity, or the strategic buyers must release metal back into circulation. Current indicators suggest neither is happening. By mid-April, the dealer inventory crisis had become undeniable, and yet futures prices remained subdued because futures are settled in cash, not metal. The paper market kept saying surplus, while the physical market kept whispering scarcity. And the whisper was getting louder. On April 18th, a document appeared, not in mainstream financial news, not on trading terminals, but in a closed-door briefing, circulated among sovereign wealth fund managers across the Gulf states. The document was 11 pages long. It had no author listed, no official seal, just a title. Strategic Metal Positioning, Q1 2025 Assessment. And buried on page 7 was a single sentence that explained everything. Physical silver accumulation accelerated 340% quarter over quarter among non-Western central banks, with zero corresponding increase in official reserve reporting. 340%. Someone was buying enormous quantities of physical silver, and they weren't reporting it because they didn't have to. Silver, unlike gold, isn't classified as a Tier 1 reserve asset under Basel III banking regulations, which means central banks can accumulate it without disclosure, without transparency, without anyone knowing, until it's already done. A former IMF economist, who now consulted privately for 3 Asian central banks, described this situation with unusual candor during a private dinner in Singapore. Gold movements, everyone watches. Every transaction over 10 tons gets analyzed, but silver moves in shadows. A central bank can acquire 50 million ounces, and nobody files a report. Nobody asks questions. It just disappears into vaults. 50 million ounces. At current prices, that's $1.5 billion. Significant, but not enough to trigger financial media attention. Small enough to accumulate quietly. Large enough to matter strategically. And the pattern had already begun. In January 2025, before the price decline, import data from Switzerland showed something unusual. Silver exports to Hong Kong jumped 847% compared to January 2024. Not gradually. 1 month, 4.2 million ounces. The next month, 35.6 million ounces. Swiss customs officials processed the shipments, stamped the paperwork, recorded the data, but no one asked who was the end buyer, because Hong Kong is a transfer hub. Metal goes in, metal goes out, destination, undisclosed. On April 22nd, a logistics analyst in Rotterdam noticed something similar. Silver shipments through Rotterdam port, heading east, had increased 290% since February. But the receiving ports weren't commercial facilities. They were military-controlled harbors in 3 countries, none of which had significant silver mining operations, none of which had major industrial silver demand, but all of which had recently announced major defense infrastructure expansion. The analyst ran the numbers twice, because what he was seeing didn't match any historical pattern. During peacetime, silver flows toward industrial centers, electronics manufacturing, solar production, but this silver was flowing towards strategic military infrastructure, and it was happening quietly. On April 29th, a defense contractor in Northern Virginia, received an unusual request, a procurement specification for a new weapons guidance system. The specification was standard, except for one line. The silver components must be sourced from North American refineries only. No imported silver, no foreign supply chain dependencies. The contractor had been building military systems for 30 years. He had never seen that specification before. He called his contact at the Pentagon. The conversation was brief. New directive, critical materials, domestic sourcing only, effective immediately. Critical materials. Silver had been reclassified, not publicly, not officially, but internally, within defense procurement. Silver was now treated the same as rare earth elements, the same as lithium, the same as uranium, strategic, critical, supply sensitive. By early May, pieces of a larger picture began connecting. A mining analyst in Perth published a research note that went largely unnoticed. Global silver mining production remains flat, approximately 830 million ounces annually, but industrial demand has increased to 690 million ounces, leaving only 140 million ounces for investment and monetary demand. Yet investment demand alone, based on ETF flows and mint sales, exceeds 200 million ounces. This creates a structural deficit of 60 million ounces annually, which must be filled from either above-ground stocks or reduced industrial consumption. 60 million ounces, a deficit. But that calculation didn't include the unreported accumulation. If central banks and sovereign entities were absorbing another 150 million ounces, as the Gulf State briefing suggested, then the real deficit wasn't 60 million ounces. It was closer to 160 to 110 million ounces, 20% of annual production, vanishing into undisclosed vaults. On May 8th, a solar panel manufacturer in California made a decision that shocked his industry. He signed a 5-year silver supply contract at $38 per ounce. The current spot price was $31.20. He locked in a price 22% above market. When asked why, his answer was direct. Because in 2 years, I don't think silver will be available at any price. Not for commercial buyers, not for companies like us. The strategic buyers are taking everything and they're not selling it back. I'd rather pay a premium now than shut down production later. His competitors thought he had made a catastrophic error. Until 3 weeks later, when 2 other solar manufacturers tried to negotiate similar contracts and were told, we're not offering fixed price contracts anymore, spot price plus 30% premium, delivery not guaranteed. Not guaranteed. For an industrial commodity, that's language used for rare materials, conflict minerals, embargoed goods, not for silver, unless silver had fundamentally changed classification from commodity to strategic asset. A former World Bank commodity strategist, speaking at a closed industry conference in May, stated what few were willing to say publicly. We are watching a quiet repositioning. Nations that understand the next decade will be defined by resource access are accumulating physical silver now. While prices are suppressed, while attention is elsewhere, they are building reserves, not for profit, but for strategic autonomy. And when the repositioning is complete, when the accumulation phase ends, the price discovery mechanism we've relied on for decades will no longer function. Because the metal won't be available for price discovery. Won't be available? That phrase kept appearing in private memos, in industry calls, in procurement meetings. The metal was still being produced, but it was no longer accessible. It had moved from the visible market to the invisible vaults, and no one knew how much had already moved or how much more would follow. But one thing was becoming clear. The decline in silver prices wasn't a market correction. It was a final accumulation window, and the strategic buyers were using every day of it. On May 15th, a conference room in Basel, Switzerland, hosted a meeting that never appeared on any public calendar. 12 people attended, 3 central bank governors, 4 sovereign wealth fund directors, 2 mining company executives, 3 independent commodity strategists, no media, no minutes recorded, just a single question on the table. What happens when the physical silver market can no longer supply both industrial demand and investment demand simultaneously? The meeting lasted 7 hours. When it ended, no official statement was released, but 3 of the attendees, within 48 hours, quietly repositioned their portfolios because they had run the scenarios, and none of them ended with market stability. Scenario A emerged first in their analysis, the one everyone hoped for, normalization. In this scenario, prices rise gradually, Strategic buyers slow their accumulation. Industrial users adjust to higher costs. New mining projects come online. Recycling increases. And supply-demand balance restores over 24 months. It was the optimistic pathway. But it required 3 conditions. First, strategic buyers had to stop accumulating. Second, prices had to rise enough to incentivize new production. Third, industrial demand had to remain elastic, able to absorb higher costs without disruption. By mid-May, all 3 conditions looked increasingly unlikely. A mining executive from Nevada, speaking privately after the Basel meeting, explained why. To bring a new silver mine online, you need minimum 45 watts per ounce silver sustained for at least 3 years to justify the capital investment. We're at $31, and even if we hit $45 tomorrow, the timeline from discovery to production is 7 to 10 years. There is no quick supply response. The market seems to think new production can solve this, but the geology doesn't care what the market thinks. 7 to 10 years, the strategic buyers weren't thinking in quarters. They were thinking in decades, and they were moving, while the window remained open. Scenario B was less comfortable. Persistent shortage. In this scenario, the bifurcation becomes permanent. 2 separate silver markets emerge. The strategic market, where governments and defense contractors access metal at premium prices through direct refinery relationships, and the commercial market, where industrial users and investors compete for increasingly scarce supply at volatile prices. A solar industry analyst who had been tracking the procurement crisis described the implications. If silver becomes supply constrained for commercial buyers, solar panel costs increase 12-18%. That makes projects in emerging markets uneconomical, which slows the energy transition, which creates geopolitical pressure, which accelerates the very strategic competition that caused the silver accumulation in the first place. It becomes self-reinforcing. Self-reinforcing, the shortage, creates the conditions that worsen the shortage, and businesses caught in that cycle face impossible decisions. A manufacturer in South Korea already faced it. His company produced advanced semiconductors. Each chip required 0.03 grams of silver. In April, his silver costs were 4% of total production costs. By June, they had reached 11%. His options were limited, raise prices, and lose contracts to competitors, absorb costs, and operate at a loss, or shut down silver-intensive product lines entirely. He chose the third option, and he wasn't alone. By late May, 3 electronics manufacturers, 2 medical device companies, and 1 defense subcontractor had quietly discontinued product lines due to silver supply constraints, not because silver was unavailable, but because it was no longer economically viable. At available prices and premiums, the market was beginning to ration through price. Scenario C was the one no one wanted to discuss openly. Monetary regime shift. In this scenario, the accumulation of physical silver by strategic buyers isn't about industrial supply. It's about monetary insurance, a hedge against dollar system instability, a parallel reserve asset that operates outside traditional financial reporting. A former Treasury official, now advising a Middle Eastern sovereign fund, outlined the logic during a private call in late May. If you believe the current monetary system has structural vulnerabilities and you want to hedge that risk, but you don't want to signal your hedge publicly, because gold accumulation is too visible and too politically sensitive, then silver becomes elegant. It's a monetary metal with industrial cover. You can accumulate it as a strategic resource, and no one questions your intentions until it's too late to question. Until it's too late. That phrase carried weight. Because if multiple nations were accumulating silver, not for industrial use, but as monetary insurance, then the current pricing mechanism was catastrophically wrong. Silver at $31 per ounce reflected industrial commodity dynamics, but silver as a monetary reserve asset in an environment of currency instability, that silver might be worth something entirely different. A currency strategist in London ran the calculation. If silver were valued proportionally to gold, based on historical monetary ratios, and if gold were repriced to reflect actual monetary system stress, then silver wouldn't be $31. It would be somewhere between $180 and $340 per ounce. The calculation was theoretical, but the accumulation was real. On June 3rd, a business owner in Austin, Texas, received advice from his financial consultant that crystallized the situation. His company manufactured water filtration systems. Each unit required 14 ounces of silver. His consultant told him, "You have 3 choices. Lock in a 3-year supply contract now at current premiums, which will cost you $340,000 up front, or continue buying spot and risk supply disruption, or redesign your product to eliminate silver and spend $1.2 million on R&D with no guarantee of success. None of these are good options, but one of them is necessary. That conversation, in fact, was happening in boardrooms across every industry that depended on silver, electronics, solar, medical, automotive, defense, every business facing the same calculation, secure supply now or risk operational failure later, and the businesses that moved first were locking in supply, while those that waited but were discovering that waiting had become the riskiest position. By mid-June, the pattern was undeniable. The silver market had fundamentally restructured from a transparent commodity market to a strategic resource under quiet allocation. Prices hadn't reflected it yet because paper markets still functioned normally, but physical markets had already diverged, and that divergence created a decision point for every business operator and investor. Do you position based on what the price says or based on what the physical market is doing? Because increasingly, those were two different answers. A veteran commodity trader who had operated through every metals crisis since 1987 summarized it during an industry call in late June. I've watched gold squeeze in 1980. I've watched palladium squeeze in 2000. I've watched rhodium squeeze in 2008. And every time, the pattern is the same. First, the physical market tightens. Then dealers run out. Then industrial users panic. Then prices explode. And everyone asks, why didn't we see this coming? Well, we're watching it happen again. Right now, in real time. And the people who understand what they're seeing are moving, while everyone else is still reading the charts. Still reading the charts, while the metal disappears. The decline in silver prices had revealed something the market had been ignoring: a structural supply deficit masked by paper market liquidity, strategic accumulation hidden behind industrial demand, and a pricing mechanism that no longer reflected physical reality. 3 scenarios, 3 possible outcomes, but all 3 shared one common element: the businesses and investors who secured physical position early would have options, while those who waited for price confirmation would have only regret. The silver wipeout wasn't the end of a cycle. It was the beginning of a reorganization, and the reorganization was already complete. Most people just hadn't noticed yet.